You've seen the headlines. Canada's lumber war is making American homes unaffordable. They spin a tale of record-shattering prices and a U.S. housing market caught in a death grip. They paint a picture of a deliberate, strategic move by our northern neighbors to choke off supply and send costs through the roof, leaving the American dream in tatters. But that's not the whole story. In fact, it's not even close to the real story. We looked at the numbers the headlines ignore, the official trade data, the commodity market tickers, and the internal reports from the forestry industry itself. What we found was a reality so completely different from the popular narrative, it has to be told. The data reveals crashing Canadian exports, lumber prices hitting lows, not highs, and a Canadian industry facing its own deep-seated crisis. What's really happening is something else entirely, and it's a story you need to hear. First off, let's acknowledge the story you're being sold. It's simple, it's compelling, and frankly, it's terrifying. It goes something like this. Canada, which supplies a huge chunk of the lumber used to build American homes, has decided to turn off the spigot. Through a mix of production cuts and trade games, they've supposedly engineered a scarcity crisis. The headlines scream about a lumber crisis and a lumber shortage that has locked the U.S. housing market. They use powerful emotional words like skyrocket and explode to describe prices, making you believe the cost of a simple 2x4 is single-handedly shattering the budgets of hard-working American families. This narrative gives you a clear villain, Canada, and a clear victim, the American homebuyer. This story gets amplified by a constant drumbeat of news about trade disputes and tariffs. Every press release from a lumber coalition or every threat of a new duty is framed as another nail in the coffin of housing affordability. The story suggests a coordinated, aggressive strategy by Canada to leverage its natural resources for economic gain at our expense. It's a narrative designed to get clicks, stir up anxiety, and make you feel powerless. But here's the critical question these headlines never bother to ask. If this story is true, shouldn't the evidence be obvious? If Canada has locked the market and prices have exploded, we should see two things clearly in the data. A dramatic, sustained drop in lumber exports from Canada to the U.S., and lumber prices sitting at or near all-time highs. The narrative is simple, so the evidence should be just as simple. But it isn't. Not even remotely. So, if that's the story being pushed from every corner of the internet, where's the proof? Well, this is exactly where the entire narrative falls apart. When you stop reading the sensationalist headlines and start looking at the actual, verifiable data from commodity markets and government trade statistics, the story doesn't just bend, it shatters. The reality we found isn't a market being locked by a foreign power, but a market being crushed by something much closer to home. The data doesn't show prices exploding to record highs. It shows them lingering at depressed levels, a world away from the panic-driven peaks of the past. The numbers don't show a coordinated Canadian effort to withhold supply. They show a Canadian industry struggling with its own profound internal problems, leading to unavoidable production cuts. The story the data tells is the polar opposite of the clickbait narrative. It's a story of collapsing demand, not engineered scarcity. It's a story of internal Canadian struggles, not external aggression. And most importantly, it's a story where the main character, the primary force shaping the U.S. housing and lumber market, isn't Canada at all. It's the United States Federal Reserve. For the rest of this analysis, we're going to take apart the headline narrative, piece by piece, using the very data its proponents seem to ignore. We'll look at the price myth, the export fiction, and the tariff shell game to reveal what's truly going on. Brace yourself, because the truth is far more complex and far more telling than the simple story you've been fed. Let's start with the most explosive claim, that lumber prices are shattering records. This is the cornerstone of the whole fear narrative. If prices aren't at crisis levels, the whole idea of a crisis collapses. So, where are prices right now? In February 2026. As of February 11, 2026, the benchmark price for lumber futures was sitting around $593 per thousand board feet. Now, you might hear that number and not know what to make of it. Is that high? Is it low? The headlines want you to believe it's catastrophic. But let's add some context. The context the clickbait leaves out. The all-time high for lumber, a level that truly did cause a crisis, was in May 2021, when prices hit a staggering $1,711 per thousand board feet. Let me say that again, over $1,700. Today's price of under $600 isn't just a little below that peak. It is nearly 65% lower. It's not even in the same universe as the crisis-level pricing we saw a few years ago. In fact, far from exploding, prices have been weak. Data from late 2025 showed the price of benchmark Western spruce pine fir was down 15% from the previous year, while Southern yellow pine was down 20%. In September 2025, as export volumes plunged, the price of Canadian softwood shipped to the U.S. fell by 8%. This is not how a commodity whose price is exploding behaves. This is how a commodity facing weak and falling demand behaves. The reason prices are low is simple economics. Demand for housing in the United States is weak. A glut of unsold new homes and the relentless pressure of high mortgage rates have kept builders and buyers on the sidelines. U.S. housing starts fell to a 5-year low in late 2025, hitting a level not seen since the pandemic shock of 2020. You don't need an economics degree to get this. When fewer people are building homes, the demand for lumber falls, and when demand falls, prices follow. The market isn't being dictated by a nefarious Canadian plot. It's being dictated by basic supply and demand, driven by affordability challenges right here in the U.S. The headlines are trying to sell you a story from 2021, hoping you won't check the calendar. The price myth is just that, a myth. Now let's tackle the second pillar of the lie, that Canada has locked the market by choking off supply. This conjures an image of a powerful gatekeeper intentionally turning a valve to starve its biggest customer. The data, however, paints a picture not of a powerful gatekeeper, but of a struggling producer. Canadian softwood lumber exports to the United States aren't being strategically withheld. They're declining because of severe long-term challenges inside Canada's own forestry sector. This isn't a move against the U.S. It's a domestic crisis playing out in real time. Take a look at 2025. In the first 6 months of the year, Canada's physical lumber exports to the U.S. fell by over 1 million cubic meters, an 8% drop from the year before. By September 2025, things got worse, with softwood exports to the U.S. plunging a staggering 22% in a single month, driven by weakening U.S. demand. This isn't a new trend. Canadian lumber production has been declining for years. Between 2017 and 2024, their softwood lumber production fell by a massive 28%. This isn't a negotiating tactic, it's a sign of deep structural problems. Mills have been shut down. The industry in British Columbia, a powerhouse of North American lumber, has been ravaged by fiber shortages, devastating wildfires, and the long-term effects of the mountain pine beetle epidemic. In fact, exports from British Columbia to the U.S. in 2024 were at their lowest volume in nearly half a century. Overall, Canadian exports to the U.S. are trending at their lowest levels in a decade. So, what the headlines frame as an act of aggression is really a reflection of desperation. Canada isn't turning off the tap. The reservoir is running low. Their share of the U.S. lumber market has been on a downward trend for nearly 30 years, standing at just over 23% in 2024. While they're still our single largest foreign supplier, that's a far cry from the monopolistic stranglehold the headlines imply. The narrative of a lock on the U.S. market is pure fantasy. This brings us to the most misrepresented part of the story, the tariffs. Every time a new review is announced, headlines scream that your home is about to get more expensive. The tariffs are real, they do add cost, and the dispute is a decades-long saga. But their role in today's market is wildly exaggerated. It's a classic shell game, where you're told to watch the distracting hand of trade policy while the real action is happening somewhere else. As of early 2026, the combined duties on most Canadian lumber cite at around 14.54%, a rate finalized in mid-2024 that was actually a reduction from previous rates. This adds a cost, but it's a known factor, not a sudden shock that would make prices explode. The real headline fodder comes from political theater. There were threats of a 25% blanket tariff on Canadian goods, which was later delayed with lumber exempted. There's the ongoing drama of the 6th Administrative Review, with preliminary numbers hinting at future rates as high as 27 to 34% for some companies, though the final results are still pending and will be challenged. And then there's the big one, the Section 232 investigation into whether wood imports threaten national security. This led to a 10% tariff on softwood lumber in October 2025. This cycle of threats, preliminary rates, and last-minute postponements is perfect fuel for sensationalism. The media reports the scariest possible outcome as a certainty. What they fail to explain is that this is a long, drawn-out legal battle. Canada consistently challenges these duties, and history shows these tariffs often inflict a net economic loss on the U.S. One analysis suggested that for every $1.6 billion U.S. producers gain, American consumers lose $2.3 billion. Now, to be fair, the U.S. Lumber Coalition argues these tariffs are essential to counter what they see as unfair Canadian subsidies and dumping practices that harm American mills and jobs. But even with that legitimate dispute, the tariffs are not the primary force driving the market right now. The tariffs are the smoke, not the fire. We're about to connect all these dots and reveal the real force locking the U.S. housing market. But first, if you appreciate analysis that cuts through the media noise to find the truth, please take a second to hit that subscribe button and turn on notifications. We release data-driven reports like this every single week, and your support allows us to keep digging. Okay, let's get back to the real story. So, we've taken apart the clickbait narrative. Prices aren't exploding. Canadian exports aren't being strategically choked off. And the tariffs are a long-running drama, not a sudden crisis driver. This begs the most important question. If it's not a Canadian lumber conspiracy, what is the real reason the U.S. housing market feels so broken? The answer isn't in Ottawa, it's in Washington, D.C. The primary culprit is the United States Federal Reserve and its aggressive campaign of raising interest rates to fight inflation. Think about it. The single biggest factor in the cost of buying a home isn't the lumber, it's the mortgage. A few years ago, you could get a 30-year fixed mortgage for under 3%. Today, rates have remained stubbornly high, dramatically increasing the monthly payment for the same house. This has had a devastating effect on housing demand, pushing millions of potential buyers out of the market. This collapse in housing affordability is the master key that unlocks the entire puzzle. It explains everything else. Why are lumber prices weak? Because high mortgage rates crushed housing demand, so builders aren't buying as much lumber. Why are Canadian lumber exports to the U.S. plunging? Because U.S. builders are ordering less lumber due to that same crushed demand. The low prices and falling exports are just two symptoms of the same disease. A U.S. housing market deliberately slowed by our own monetary policy. Canada isn't the actor here, they are reacting. Their struggling industry is getting hit with a double whammy, a long-term decline in their ability to produce, colliding with a short-term, policy-driven collapse in demand from their biggest customer. They aren't pulling a lever. They are feeling the shockwave from a lever pulled right here in the U.S. And this is why understanding the real story matters. If you believe the headlines, you might demand more tariffs against Canada. But based on the evidence, that's like trying to fix a broken leg with a cough drop. It completely misdiagnoses the problem and would likely raise costs for consumers without addressing the root cause: affordable financing. The real conversation we should be having is about domestic housing policy and interest rates. Now, just because the current narrative is false doesn't mean there are no risks on the horizon. The media's greatest trick is to present a genuine future risk as a current reality. A smart analyst knows the difference. So, let's talk about the real what-ifs that could actually cause lumber prices to spike. First is a severe escalation in the trade war. If the upcoming USMCA joint review in July 2026 goes badly, or if worst-case scenarios from other disputes play out, we could see duty rates climb to 30% or 40%. At that level, Canadian lumber would get much more expensive, and U.S. prices would have to rise. The second risk is a rapid V-shaped recovery in U.S. housing. Imagine the Fed cuts interest rates faster than anyone expects. Suddenly, millions of buyers rush back into the market. If this happens before the struggling Canadian industry can recover, you'd have a classic supply-demand squeeze, and prices would rise sharply. The third risk is an intensification of Canada's internal supply problems. More catastrophic wildfires or permanent mill closures could slash their export capacity even further, regardless of U.S. demand or tariffs. North American mill capacity has already been reduced by billions of board feet in recent years, tightening the overall supply cushion. These are the real storm clouds on the horizon. The key is to monitor them without letting them obscure the current weather. Your job, as an informed observer, is to separate the signal from the noise, the forecast from the fact. Let's circle back to where we started. The headlines scream a simple, frightening story. Canada has locked the U.S. housing market and caused prices to explode. We have shown this to be a fiction. The data tells a profoundly different story. A story of prices that are historically weak, hovering nearly 65% below their all-time highs. A story of a Canadian industry in crisis, with production falling for years and exports to the U.S. trending at decade lows. A story of a complex tariff dispute that is routinely misrepresented for clicks. The real story, the one supported by the numbers, is that the U.S. housing market isn't being held hostage by Canadian lumber. It's being held hostage by high interest rates and the resulting collapse in affordability. The weakness in the lumber market is a symptom, not the cause, of the struggles facing American homebuyers. Canada isn't the puppet master. They are just another puppet like the rest of us, dancing on strings pulled by the Federal Reserve. Understanding this distinction is critical. It shifts our focus from a pointless trade war to the real issues of domestic monetary policy, housing supply, and American industrial capacity. So the next time you see a headline screaming about a lumber crisis, ask yourself, are they showing you the data? Are they giving you the context? Or are they just selling you a story? Because the story that sells is often the one that scares. But the real story, the one that empowers, is almost always in the numbers.